All right.
I mean, it's kind of funny. It's funny, not funny, kind of.
Here's something that someone might say. Well, remember in 2008, 9, everything came down like in half. And so I don't want to, you know, get this rate right here and then the payment goes up and then my property value goes down. So, you know, I'll wait till the
Yeah, I
properties
mean,
come down.
yeah. Properties are always going to ebb and flow. Something is going to make properties go down. We, as real estate professionals and financial professionals, are not seeing anything on the horizon short term to make property values go down. If anything, like we've discussed on this call, there are a lot of things that are going to make property values go up. The main thing is interest rates. As interest rates go from 7% today to 6% a year from now to 5% 2 years from now, which even Freddie Mac is saying, property values rationally are going to go up because I myself, I'm one loan officer. I have 35 buyers waiting for interest rates to go down. I just can't convince them to get on the market, start making offers, start making competitive offers, and buy their homes. And I'm just one loan officer. Multiply that times a few tens of thousands in this country waiting for interest rates to go down. So when interest rates do go down, you're going to have a flood of buyers to increase very naturally. It's a very natural supply and demand, free market capitalism thing to do. It's not doing bad loans, which is what made property values go down previously. We were giving away money for free, and that was not a very good decision. That's what made property values go down. There's nothing on the horizon that short term in the next 2, 3 to 5 years to make property values go down. They're not going to do anything logically but go up.
So what I'm hearing is the rates are projected to go down,
Mm-hmm.
and when the rates come down, you project that the property values are going to go up.
And it's not just me. I mean, if you're a buyer who's on the market, who's been on the market for at least 2 to 3 years, you see what happens when interest rates go down. All of us saw COVID. As a personal aside, as an opinion, it was a brilliant idea to make interest rates low during the worst pandemic we've seen in 100 years, regardless of your politics. That was a great idea to keep interest rates low and to make them even lower so that businesses could borrow money while their businesses were not doing good. People could buy and sell real estate very, very, very easily. Property values went through the roof, and really rates only went from 4.5 down to 3, 1.5%. That's what the COVID boom of property values happened. What Freddie Mac is telling us is that today's interest rate, 6.5 to 7%, 2 years from now is going to be 5%. So, we just saw it 3 years ago. We just saw this happen. The only thing to make the buyer feel like they do know what they're talking about, because there is some truth in this. At some point in Southern California, with these property values, we're going to get to a point that a well-paid married couple can't afford a home. At some point, we're going to get to that point. 65,000 to 68,000 is the median income right now. In some neighborhoods in Southern California, a married couple with the median income and no debt whatsoever can't qualify to buy a house. They need a brother or a grandmother or somebody else on the loan to qualify just to make the mortgage payment. So at some point, homes are going to become unaffordable, and that might stagnate property values, but there's still going to be equity to be made. What needs to happen, another kind of political aside, what needs to happen is salaries need to raise, because inflation, gas, eggs, and houses are much higher than what our current minimum wage and our current median income is. I'm going to just leave it there. And that would help the economy out a lot if these people, doing the work in our country were actually paid what they're worth.